Pull the trigger.
How's it going, traders? And welcome back to Paradigm Flip. Hope you're all doing well. In this video, we're going to be touching on risk on and risk off flows. Now, with my students, we are basically moving on to the topic of intermarket analysis. And I thought, what a better way to start off the topic of intermarket analysis than to share with my YouTube viewers a bit of insight into what we do in our group, and also to give you guys the ability to go out and look for some trades for yourself, right? And to have a better understanding of what's going on in the world of real trading. Now, what we have on the chart is the Australian dollar and the Japanese yen, and I thought I'd just share a live example in real time, right? So I am going to be calling a live trade, right? Currently, I am on the Australian dollar JPY, right? Let me just get my time zone right, and it is 12:22, right, in the afternoon, Johannesburg time, and I'm expecting that the Australian dollar make another leg up into this level, right, that we have on the chart right here. All right, and you will be able to go back in your chart depending on the time that I post this, right? You can go back and see for yourself whether the trade panned out or not. Now, no trade is guaranteed to work out, right? And this doesn't mean that you cannot call the market, right? Because losers do occur, right? Let's get that straight. Not everyone is going to be 100% successful, and there's no strategy that's going to be 100% successful in the market. And I always say that we are always dealing with a probability when we are trading, and you are supposed to play your edge when the probabilities are in your favor. Right. And if you look here on the chart, right now we are on the Australian dollar, Japanese yen, and I'm expecting it to trade higher into this level, right? As I've outlined here with this blue line. And the reason for that is because if we just look at the US 500, right, or the S&P 500, which is the purple line, you'll see that it is expanding higher, right, at a point in time where the Australian dollar Japanese yen has dropped into a previous level of support. Now, this buy zone that we have on the Australian dollar Japanese yen, right, if I just make sure this is a viewable color. Now, this buy zone that we have on the Australian dollar Japanese yen, right, is this whole area here, right? If I divide this previous support level, right, or this previous pullback, dividing it from the high to the low and drawing the 50 line, right, this whole area is the buy area, right? So this is the zone where we are looking to buy. So price could consolidate in this area, right? But we are still expecting it to trade higher. Now this trade will be negated, or we will stop trading this or looking for buys, right, if we break below the zone and we start to hold right below this area. Okay, and that's basically what we're looking for. And right now we are in that area, right? So we can be looking for that buy trade, right, to this area, right? And the reason for that is twofold, right? We look at more than intermarket analysis, right? And if I just show you another chart other than this, right, before we go into the risk on and risk off lesson within this video, which is simply the Australian dollar JPY daily chart, right? You will notice on this chart we have this indicator at the bottom of the screen here. Now, this indicator basically tells me when I should be trading my strategy and when not to be trading my strategy, right? So it is basically a market filter. Right now, I've spoken about market filters before, right? And we've looked at some mean reversion filters, right? But this one is basically a multifold filter, right? So it tells you when the market is mean reverting or trending, right? And if this line is moving upwards, that basically tells you that the market is trending. And you can see right now we have basically this line moving upwards right at this point. So this tells us that the Australian dollar JPY on a daily chart is in a trend, right, in an upward trend, and you can see that. Okay, we have basically had a few days going higher, right, and the current day is actually a bullish day, right, but we have a slight pullback, right, so we can expect the market to continue trading higher, right, and there's basically no reason for me to anticipate any reversals at this point in time. Now, if I simply draw a market profile over this swing point, right, what we want to do is find the area of highest volume within this leg, right, and you'll notice that this is shown by this red line here, which is the POC of that move, right, and if I just zoom in, right, that's the area of highest volume, right, so this is a key level where we can expect some resistance to occur. Now, price has come close to that level and we are rejecting off that level, but we can anticipate price to go higher and actually reverse at that level. Right, so that's where my target is on the previous chart. Right, so not only do we have intermarket analysis in our favor, we also have trend within our favor, right, and we can expect and anticipate this trend to continue, right, this uptrend. Right. In addition to this, if we just go back to the previous chart that we were looking at, and we just go to a daily chart on this chart, right? And what I'm going to do is I'm simply just going to remove this type, right? Because we know what that is. That's our target. Okay. What you'll notice, if I just rescale this and zoom in a bit, right? What you'll notice is that we moved away from the moving average, right? Two standard deviations, right? Around these areas and around this area here. So we could have expected some mean reversion from this point, right? Back to the moving average, right? From this area here, right? So on this candle, right? We could have anticipated a slowdown of momentum, right? Or a full on reversal back to the moving average. And you can see that is underway, right? So the current trend has more confluence to the upside, right, than to the downside. And you'll also notice that on a daily chart, you can see that the S&P 500, right, has been moving higher, right? And this is basically showing us a risk-on environment, right? And in a risk-on environment, Australian dollar JPY tends to move higher. That is its natural inclination, right? When the S&P 500 moves higher, the Australian dollar JPY moves higher, and that is basically the crux of the lesson, and we will get into the reason why, right? And you can see that the S&P 500 actually created a bottom before the Australian dollar JPY bottomed out, right? And therefore, the S&P 500 was actually a leading indication for the direction of the Australian dollar Japanese yen, right? And that's the power and importance of intermarket analysis, right? So we can just go back to our lower time frame, right? And we can just go back to the 30-minute chart. So we can just go back to the lower time frame and we can monitor this move, right? You can see that on a lower time frame, the S&P 500 is moving higher, right? At a point in time where the Australian dollar JPY is actually moving lower into a support level, so we can expect buying at this level, right? And let's just explain the reason for this, right? Now, when it comes to intermarket analysis, right, one of the key things is to understand what drives certain markets, okay? And one of the biggest drivers of forex currencies are risk on and risk off flows, right? So I'm just gonna type that in. right? And risk off flows, right? Now, what are risk on and risk off flows, right? These are basically the different market environments, right, that influence investor behavior, right, or are a result of investor behavior, either of the two, right? Now, a risk on environment is basically an environment where investors want to take on risk, right? And they do this because the global economy and the growth outlook is positive, right? And outlook, okay. And when investors feel like the global economy is stable and expect growth, right, they will invest their money in assets that are going to grow, right? Or invest their money in growth assets, right? Like the S&P 500. Okay. If the global economy and the global outlook is positive, right, companies are also going to do well in such an environment, right? Therefore, indices or indexes are going to be positive, right? They are going to basically grow. Companies are basically going to grow, and investors also want to be a part of that growth, right? So they put their money there. Okay, and that's a reason why the S&P 500 is linked to growth, right? So when the S&P 500 is increasing in value, right, that's a risk on environment, right? And when it's decreasing in value, right, that's a risk off environment, right? And if we just look at what a risk off environment is, right, this is an environment where investors do not want to take on risk, right? The reason being is because the outlook is negative. The outlook of growth is negative, and the global economy is not stable, right? So there's global instability. So, for example, if there's war, right? If there's a pandemic, for example, okay, all those environments lead to global instability, right? And cause traders to be risk off, right? Or investors to be risk off, right? So in such environments, right, a lot of companies lose money, right? So a lot of companies contract, right? So therefore, investors pull the investments out of these companies or out of indexes, right? And that causes the S&P 500 to drop, right? So when the S&P 500 is dropping, right, that is a sign of a risk-off environment, right? Now, how this plays off with currency pairs is that certain currency pairs also tend to increase in value in a risk-on environment and decrease in value in a risk-off environment, right? So in terms of currencies, right, we have high interest rate currencies, all right? And on the other spectrum, we have low interest rate currencies, all right? Now, low interest rate currencies are known as safe havens, right? So they are a place of safety, okay, during a risk-off environment, all right? So when we are in a risk-on environment, right, because there is growth, right, currencies with a high interest rate tend to do well, right? Because this is an environment where interest rates are increasing, right? So if interest rates are rising, right, people want to invest in currencies with the highest interest rate, okay, in such an environment, right? Because they want to take advantage of that, right? They want to take advantage of growth, okay? And high interest rate currencies are going to grow or increase in value, right, in a risk on environment. And that's because interest rates increase in a risk on environment, right? So our high interest rate currencies, Australian dollar, CAD, the Canadian dollar, right? we have the New Zealand dollar, right? We have the GBP USD, right? We also have the US dollar, right? But the US dollar tends to be more of a safe haven, and we'll get into that. Okay, so just remember that. Okay, now in our low interest rate currencies, right, we basically have the Japanese yen, right? We have the Swiss franc, right? And although the US dollar is not a low interest rate currency, right, it is termed a safe haven, right? So in a risk-off environment, people put their money in US dollars, right? And the reason for that is because it is the global reserve currency, right? Everything is priced in dollars, right? And also you have the American bond market, right? The US bond market, which is basically termed risk-free, quote unquote. Okay, and in order to attain those, you have to first convert your currency into US dollars, right? In order to get bonds, right? The US dollar bonds. And because of that, right, during a risk-off environment, investors tend to put their money or convert their money, right, into US dollars. Okay, so that's an important note there. Okay, so the US dollar is a safe haven currency. All right. Now, what you typically want to be doing, right? And just to explain this a bit more, right? If you look at the interest rate of the Japanese yen and the Swiss franc, these currencies basically have a negative interest rate, right? So because the interest rate is negative, what this means is that if you put your money in a Japanese bank or a Swiss franc bank, right, you will lose money based on whatever the interest rate is, right? So if the interest rate is negative one, right, percent, that means if your money is in this bank, right, you will lose 1%, right? And if your interest rate is positive, for example, like the Australian dollar, if your interest rate is, let's say, for example, 5%, right? If you put your money in this bank, right, your money will grow at 5%. Okay, it'll grow basically at the interest rate, right? Now, the opposite is true. If you borrow money from the Japanese yen bank, right, the bank will owe you interest at 1%, right? But if you borrow money from an Australian dollar bank, right, you will owe the bank an interest rate of 5%, right? So what investors tend to do is that they borrow from safe havens, right? And they invest in a bank where their money can grow, right? So these are borrowing currencies, right? The Japanese yen and the Swiss franc, right? And this happens during a risk on environment, right? And this is basically called the carry trade, right? Now, the opposite is also true. In a risk off environment, right? Yields tend to go down, right? And yields are basically your interest rates, right? Now, if yields go down in a risk off environment, right, then these high interest rate currencies or the interest rate on these currencies will lose value faster than these ones, right? So in a risk off environment, people tend to rotate out of these currencies, right, and put their money in safe havens, right? And that's because these currencies already have a negative interest rate and their money will be safe there, right? Because they have a negative interest rate, the interest rate is less likely to drop, right? If you think of an Australian dollar interest rate, right? If this is the interest rate, an interest rate chart, right? And this is 0%, this is -1, this is -2, right? Let's say this is positive 1, right? This is positive 2, right? Let's say you have here in green, right? Let's say you have the Japanese yen interest rate at negative 1%. And let's say, for example, you have the Australian dollar interest rate right here at plus 2%. Okay. In a risk off environment, right, the downside risk on the Australian dollar interest rate is more, right? The Japanese yen interest rate is already negative, so it's less likely to drop any more, right? So what people or investors are going to do is they're going to take their money out of this bank, right? They're going to switch from Australian dollars, right? They're going to rotate out of Australian dollars and put their money in a Japanese yen bank. And that basically means they'll have to sell the Australian dollars and exchange them for Japanese yen, all right? And that's in a risk off environment. And in a risk on environment, they will reverse that trade and do the opposite, right? They'll basically sell the Japanese yen and buy Australian dollar to take advantage of the growth that occurs, right, when this yield rises, right, during a risk on environment. Okay, and that's basically the idea behind risk on and risk off. And the main premise of it is this carry trade, right? So you can do extra research on that on your own. Okay, it's very important. Okay. Now, like we've said, right, previously that when we see the S&P 500, right, the S&P 500 is an indicator of growth, right? When it's rising, it means there's growth and it rises in a risk-on environment, right? When it's falling, that means there is contraction, okay, and that is a risk-off environment, right? So by understanding this, right, if investors are pouring money into the S&P 500, that means that investors are risk on, right? And if investors are risk on, that means that in such an environment, investors will also tend towards buying Australian dollar and selling the Japanese yen. So they will rotate into these assets and rotate out of these assets, meaning they will buy these assets and sell these assets, right? And very often, right, the currency tends to lag the S&P 500 index. So if you look at Australian dollar JPY during this period, you can see we had a very sharp move higher, right? Indicate on the S&P 500, indicating that we were in a risk-on environment, right? However, look at where Australian dollar JPY is, right? It's pulling back and it's much lower. So investors will see this as an opportunity, right, to buy up, right, the Australian dollar JPY and hedge it against the S&P 500, right? So they will have a market neutral trade. Now that's going a bit deeper. But what you need to understand is that when you see the S&P 500 going higher, faster than the Australian dollar JPY, right? That's a leading indication, right, that you can expect buying to occur in the Australian dollar JPY. Not all the time, but very often, right? This is an extra confluence, right, for your trade ideas. Now, the reason for this is that investors still need to accumulate the Australian dollar JPY, right? And that's what's happening here, right? They need to buy up the Australian dollar and sell Japanese yen, and that may take time, right? And the impact of the buying, right, in the S&P 500 may happen faster, right, than the Australian dollar JPY. That can cause the Australian dollar JPY to lag behind, which is a good thing because that gives you an opportunity to identify the trade and enter the trade. Okay. And you can actually take advantage of those opportunities, right? And it's going to add extra confluence to your trading. Okay. And this is some very advanced stuff. Okay. Now we can just remove all this from the chart. Okay. And we can actually see that the Australian dollar JPY is actually rising, right? And I'm expecting it to take out this high, right? And at least reach this level. Okay. And that'll be all for this video. Now, I hope you learned something and you can go and do some extra research on this topic, right? And you can try and apply it to your own trading. And if it works for you, great, right? And all that I ask is that you leave a like and a comment on your thoughts, right, in the comment section below, right? And you can also ask me any questions that you'd like in my Telegram group. The link will be in the description. And if you have any video suggestions or any video topics that you'd like me to cover, feel free to ask me in the comment section below. And I thank you all for joining and watching this video. And I appreciate your time. And until next time, I'll catch you all on the flip side.